To start off this week, I kind of wanted to kind of take a step back. And I feel like I haven't done a great job of taking a step back on the macro side of things or the traditional financial side of things in the newsletter. I've been, I think, kind of focused on more in the short term, what's going on this week, what's going on with current price action. So I really wanted to take a step back and spend the first section of the newsletter just explaining what are some of those basic forces from a high level. What are the forces that are kind of driving price movements across securities in commodities markets, and just kind of explain what's going on worldwide from a very high level macroeconomically. So I'm not going to dive into that on this space. If that's something that you're interested in learning more about, highly recommend going and read the newsletter. It's about the first page or so. But really what happens is the end of the conclusion that we can draw is, to summarize what's going on across the entire market right now. I think the main question to be asking yourself is, how far can the Fed push interest rates to lower inflation without causing a severe liquidity crisis in the treasury market like we already saw in England and Japan? So I think that's kind of the name of the game at the moment. How we get to that conclusion, you would have to go read the newsletter. Like I said, I'm not going to break it down here. But this week on the more traditional general market update, in the UK, their headline CPI inflation came in at 10.1% year over year for the month of September. That puts the United Kingdom's CPI at July levels, but before that, it was the highest since 1981. Back here in the US, we're continuing to see this weakening of the housing market. There was some new data released this week from the US Department of Housing and Development, which indicates that in the month of September, U.S. single-family housing starts hit its lowest level since May of 2020. So for those of you who don't know, housing starts refers to the number of new homes that began construction in a given month. So for September of this year, the number was 892. That's in comparison to 750 in May 2020 and just over 1,300 in December of 2020. So it's kind of just showing this weakening of things over in the housing market. And unsurprisingly, it's resulted in this declining optimism from home builders. So if we look at the HMI, the Housing Market Index, it indicates to us that in the month of October, it was the 10th straight decline for the HMI. And the HMI is essentially a survey of sentiment among home builders. So the level that we're at as of October of this year, if we ignore this, there was a super brief V-shaped recovery in 2020. It dipped really low and then shot back higher over the course of a few months. So if we ignore that, home builder sentiment is currently at its lowest level since 2012. So those two data points that I just discussed, housing starts and HMI, are basically coming at the result of this rising cost of capital in the U.S., right? You have high interest rates that are increasing by the day, at least in the mortgage market. And then you have inflation as well that are just dissuading individuals from making these large and I would consider relatively discretionary expenditures, such as building a new home. As of yesterday, according to Freddie Mac, the U.S. average 30-year fixed mortgage rate is just under 7%. There's a few other data providers that are showing 7.2%, 7.3%. As I mentioned in the newsletter last week, I like looking at Freddie Mac, but as I explained last week, it's relatively arbitrary whether the average is 7 or 7.1 or 7.2. In the energy market, I thought it was worth noting in the newsletter that the White House announced their plan to sell the remainder of the 180 million barrels of oil from the strategic reserve that were approved for release in May. So they're going to sell, or planning on selling 14 million barrels through the end of this year, which is obviously an attempt to flood the market with supply to lower prices heading into the November 8th midterms. And then once those barrels are sold, the U.S. is planning on refilling those strategic reserves beginning in 2023 through 2025, I believe, is the current plan. So then I talk a little bit about more about oil and what's going on there. We talk about the OPEC production cuts, which I think could, or are likely going to work to raise European energy prices even higher heading into winter, which is obviously an issue. I touched a little bit on Apple and the production cuts of iPhone 14, which I think is a relatively recessionary signal. As I mentioned with the housing starts, just in a highly inflationary environment, you're going to see a cut of discretionary spending and, buying a new iPhone when you have to spend more at, the fuel pump and at the grocery store and on your interest payments. Who wants to go out and buy a new iPhone for whatever it is, $1,200? Um, and then in the fixed income market, I think it's been a super interesting week. I started off, this section talking about, or this bond section talking about junk bonds. First, I explained what junk bonds are, in case people are unfamiliar with, bond ratings and things like that. But essentially, what we're seeing is some weakness in junk bond prices this week. They bounced alongside the equity indexes last week, heading into early this week. And then yesterday we saw this reversal lower that I think could lead the equity indexes lower. Today, that potentially is not the case, but obviously, there's a lot of time left in the session. So I guess we'll see there. But this week we saw the 3-month Treasury surpass 4% yield. We saw the 2-year cross 4.6%, the 10-year above 4.2%, also the 30-year above 4.2%. So this is, to me, just signaling this lack of confidence or extreme fear from smart money investors in the short-term economic conditions of the United States. And to further highlight that, we talk about the yield curve, and then specifically we go into the 3-month to 10-year spread, which has just flipped negative this week for the first time since 2020. So that's showing us, a lot of people have heard of the 2 to 10-year spread. I think the 3-month to 10-year spread is an even stronger indicator of a potential incoming recession, just because it doesn't flip negative as often as the 2 to 10-year does. So I just thought that was worth noting, and we talk a little bit about that in the newsletter as well. And then from there, we kind of get into equities and what's going on in the equity indexes. Not a ton to touch on here, for this space, but I, recommend going and reading the section. I think there's a few industry groups of stocks specifically that are outperforming this week, or at least compared to the general market or the market indexes. That would be mostly energy names. A select few medical companies, iron and steel companies also look great, or not great, but better than the general market. And then from there, we kind of go into my crypto exposed equity section. I break down SI earnings a little bit because, in case you missed it, they reported after Monday's close. And the market clearly wasn't impressed. They were down. Shares were down 23% on Tuesday. So we break down those numbers and talk about why maybe the market reacted the way it did. And then for Bitcoin TA, essentially we're just seeing this contraction in volatility, right? That shouldn't be a shock to anyone. It's gotten fairly boring, right? It's Bitcoin. It's hovering around 19K for the last few weeks. So to me, it looks like we're gearing up for a relatively large move. I don't know which direction that's going to be in. I would say based off of the current trend in price action over the last few months, there's a higher likelihood that this large move could be to the downside. But obviously, that's just me speculating. I don't know. No one knows what's going to happen. But that about sums it up for everything I wrote about. If anyone has any questions, feel free to DM me.
Blake, do you think we'll see because isn't the Fed kind of like tries to get yields higher than CPI? Is that right? Do you think that's going to happen?
I'm not really too sure about that. They're trying to push yields above CPI,
or like that's the sign of a recession. I feel like I heard that somewhere.
It's possible. But really, what a lot of analysts like to look at is where is the Fed funds rate in comparison to certain yields. So like the 3-month is a good example. So you've probably heard the saying like behind the curve, the Fed's behind the curve, or things like that. So it's looking at where is the market putting interest rates on Treasury bonds. So the 3-month at the moment is sitting at right about 4%. So that's the market saying here's where we're going to place interest rates based off of price action and human psychology and all the things that move markets. And then a lot of people would believe that it's the Fed's job to catch up to what the market is saying. You could also, the 3-month is just one example. A lot of people use the 2-year for this as well. But in terms of where CPI to yields, I'm not totally sure that that's where the Fed's focus is at the moment.
Blake, I think that was excellent coverage of the macro section. I'm curious to get your thoughts. I've seen this a few times, at least on Twitter in the past, and it's how currently uh, Bitcoin's volatility compared to other fiat currencies like the pound is actually about the same, or the pound is quote unquote more volatile right now. And I think that's kind of funny, kind of interesting. I guess I personally don't kind of think it's just a coincidence that Bitcoin has just been kind of stagnant, not moving, and the pound has just been, and other fiat currencies have just been extremely volatile. Do you think it's a coincidence, or do you think it's a sign that there's going to be extreme volatility, going forward in other currency markets?
No, I'm kind of in the boat that it's more of a coincidence. Obviously, you have I mean, the markets just go through periods of, on individual stocks and in the indexes, whatever, we'll have contracting volatility, which is kind of just a signal that, if you like to think about the stock market, I like to think about it this way, like this battle between buyers and sellers, right? And when buyers are winning the battle, their prices are rising. And when sellers are winning the battle, prices are falling. And then when this battle is really intense between buyers and sellers, you're going to see this contraction in volatility because no one's able to move price very far. And that's just something that comes naturally. I think it's part of human psychology and just how price action works in general. So you're always going to see periods of contracting volatility, and that just happens to align with the period over in the United Kingdom, where they're having some, obviously currency issues because they're having a lot of issues in their treasury market and with their yields. And obviously we talk about that in the newsletter, as I mentioned before in that first section, just a little bit about what's going on in England with their, with the Bank of England and what's going on in their pension system. So I think, long story short, I think it's a coincidence, but obviously I could be wrong.
Are the problems with the pound that's going to affect U.S. our ability to export goods, right? So that's going to probably make our recession come sooner.
Not necessarily. I think, well, I mean, if you think about it this way, like when you're looking at currencies or the strength of currencies, you're just comparing them to other currencies. Obviously, like the U.S. dollar is the gold standard to compare currencies against. So when you're seeing, and the pound's made a little bit of recovery, but when you're seeing, overall weakening currencies in the U.S., that's why the dollar's been unusually strong in this period. That does hurt U.S. manufacturers because it makes your exports less competitive in the global market. So I think, yes, it's going to have some effect. I just don't know how large that, and I think there's no real way to measure it. Like if the pound was stronger, if the yen was stronger, whatever, would the recession, take longer to, come to fruition? I don't know. And I think it's kind of impossible to measure.
Yeah, just to add on, in a way, weak foreign currencies compared to the U.S. could potentially, I don't know, maybe even ease recession concerns as our dollar goes further buying foreign goods.
Yeah, and another thing that I think is interesting is so like some of the largest holders of U.S. Treasuries in the world are foreign governments. So I want to say number one is Japan, number two is China. So what you see is that they load up on U.S. Treasuries when the dollar is relatively weak, and then they sell them off as the value of the dollar rises. So this is another one of the factors, and once again, as I explained in this beginning section of the newsletter, I think the illiquidity of the treasury market is one of the two drivers of what's going on in this environment. So you're going to see, as the dollar is rising against foreign currencies, you're going to see these foreign entities or pools of capital selling U.S. treasuries. So that kind of combines with quantitative tightening in the U.S. It combines with U.S. institutions being already full of treasuries to suck liquidity out of the market, which is obviously a pretty big issue. It can lead to big issues like we saw in England and in Japan as well.
Is America going to have to do yield curve control?
I don't know. I think it's not a good idea. I don't think we'll necessarily go to yield curve control. obviously, as many people I'm sure would agree with me, I could see the U.S. Flipping back to QE in the not super distant future. I think the difference between, or I should say, the difference between England and Japan versus the United States is that our treasury market is largest in the world, and we have this, a much larger depth of liquidity versus those markets. So it's relatively easier to break your market, with one big domino falling like England's pension system than it is for the U.S. Right? It takes a lot more economic pressure or fiscal pressure to break the market like that.
Yeah, that makes sense. With that, we can shift gears to on chain, and you sort of alluded to this, Blake, talking about Bitcoin's been hanging around this 19K range, the low volatility. Let me pin my thread to the nest real quick with the on chain charts. There you go. So first is the 200-day moving average and the 4-year moving average. Bitcoin hasn't really been below the 4-year moving average ever. This is sort of unprecedented, which makes me optimistic that the next bull market will be unprecedented to the upside. Um, we'll be looking to see if Bitcoin can flip the 200-day moving average before we say like the bottom of the bear market is in. And same with the realized price. So if Bitcoin can get above short-term holder realized price, which they're getting closer now, and then that'll be a good sign that maybe the bottom is in. And then if Bitcoin is able to get over the long-term holder realized price, then like that's definitely like a really solid indicator that the bottom is in. The one chart I really want to talk about today is realized volatility. So this is a metric that's fairly new to Glassnode, but we're at a really low level of realized volatility right now. And every time previously has been every time this level has been this low previously was prior to either a really big move up or a really big move down. So it happened right before the 50% crash in the 2018 bear market. It happened multiple times before like huge run-ups during the 2017 bull market and the 2013 bull market. And it happened right before we started to take off in late 2020. We're at that level now. So like obviously anybody can predict, oh, Bitcoin's going to go up or down like that. It doesn't take much like thought there. But like we definitely are about to make a big move, and the point of on-chain is not to call which direction that's going to be, but rather to just see where we are in the broader Bitcoin cycle. So based off of this metric and others, we're either we're going to get one more final bloody nasty capitulation drop down, or we're about to start ramping back up. And either way, that means the bottom of the bear market is either just behind us or just in front of us. So this is really the time to grind and stack sats. Another metric showing we're at the bottom of a bear market is when you look at active addresses. So when you compare the 30-day moving average with the 4-year moving average, we're about to touch. That happened in the 2018 bear market. So as you guys know, during bear markets, all the tourists leave. It's just the hardened Bitcoiners that remain. So the short term moving average of active addresses is going to be lower. But what you see with the 4 years, this steady, constant increase, and that's just the underlying adoption of Bitcoin as a technology. We're not going to see the 4-year moving average of active addresses decrease because there's just constant Bitcoin adoption happening. Even if it is slower during the bear markets, the bull markets definitely kick up the rate of adoption, but it's always there. To tie into the low volatility, we've talked about this the last 2 weeks in the newsletter, but the amount of non-expiring futures contracts relative to market cap it hit another all-time high this week. So the market is extremely leveraged right now, and I suppose that's just investors. They're gearing up. They want to profit on a big move up or down. I personally am not trying to trade short term because, like I said, on chain is not for trading short term. I don't recommend. I recommend a dollar cost average. That's not financial advice, but that is what I do. I dollar cost average, especially during a bear market such as this. HODL waves, we talked about this before as well, but it's just really important to emphasize that the amount of Bitcoin that has not moved in a year is at an all-time high. Nobody who is held from 69K is going to be a forced seller at the bottom unless they absolutely have to pay the bills to survive. And even when you you consider that idea, the only people who in these hodl waves would really be forced to sell, if you think about it, is like the 1 to 2 year, maybe the 2 to 3 year category, because anybody who's held Bitcoin for 3 or more years, chances are they don't need to sell to survive. They've been in Bitcoin long enough that they're probably good from a financial perspective. So we wouldn't really expect them to be forced sellers at this point. And then when you look at the hodl waves during the bull market, you saw that they took some chips off the table. They took some profits when we were up in the 60K range. So that those people are probably fine now. And even then, the 1 to 2 year and 2 to 3 year holders, they're not going to sell unless they absolutely have to. So all the supply that's not moving, obviously that's not going to get sold. So that's less sell pressure. And in this battle of buyers versus sellers, we should see the buyers hopefully win a battle here soon. And lastly, this isn't really important at all, but I noticed during the Amsterdam conference, the European Bitcoin trading hours premium actually, like, it almost flipped positive. It's been negative for the last, like, it's been a trading deficit during European hours for the last few months, but it sort of peaked out during the European conference. So I don't know if that's just a coincidence, or maybe the European conference moved the needle a hair on Bitcoin. So I just thought that was interesting.
Nice, Mitch. I think that was very interesting. I'm kind of interested to learn more or get your thoughts on this open interest relative to market cap chart that you posted in the newsletter. To me, it's interesting how it's just been ripping, since middle of 2022. I guess a lot of that can just be attributed to the lack of volatility, right? Maybe there just has been a lack of liquidations in the futures market for Bitcoin. So there's not really much open interest getting cleaned out on major moves. And instead, it's just, gamblers getting in and adding to their position or opening more positions, or new people trying to bet on the price of Bitcoin, but they haven't really closed out their position just because there hasn't been that volatility that forces them to close out their position. Do you agree with that, or do you have a different take?
No, I agree 100%. I think that's definitely got to be what's going on. So when we do get this nasty move, we should see a lot of positions close out at once, which is going to make the move even nastier.
Yeah, definitely. And yeah, I think the whole idea behind that, the other chart that you were talking about, the realized volatility, I definitely agree that we're basically obviously on the precipice of a major move in Bitcoin. And it's easy to say that because this is Bitcoin. But I also agree that if we do see another leg down in a major capitulation, I would imagine that's probably going to be one of the last legs. I mean, it could be very deadly and violent. But historically, whenever volatility gets this low, and we've been in a bear market for this long, it's kind of like, all right, if we go lower, we go 50% lower. That's the last leg, and that's the time to really, get into Bitcoin.
Yeah, I agree 100%. And I honestly don't know that there's anybody who would disagree with that, right? Like if we go 50% to 10K, I would think that's like the maximum level of bearishness. I don't think anybody thinks we're going to go as low as 5K. But when you factor in that sort of mindset, that makes me optimistic, and maybe we won't have that bloodiness, right? Because I think at the bottom of a bear market, you're going to see people being still bearish, right? And if we go further, like, how much more bearish can it get?
Yeah. And to me, I think if we did see another capitulation leg in the price of Bitcoin, I would imagine we would be seeing the exact same thing in U.S. equities, and I think that would be, to the point where it would certainly cause a Fed pivot. There would be, massive, financial problems all throughout the system. So I think, yeah, if we do have that next leg of capitulation, it could get worse, but I gotta imagine that would be it.
Yeah, I agree. It would be more like a spring of 2020 type situation where it's really quick down and really quick back up, versus 2018 where it's really quick down and then a grind back up. Because I think right now is where we're starting to sort of grind. And if you're right, if there's one more leg, it's not going to be like it's going to be an outside event most likely that affects all markets, not just Bitcoin.
Cool. I can transition it to our last segment, the mining segment. There's a few things that I want to talk about this week, and obviously it's all in the newsletter. The first one was a tweet that I saw from Ethan Vera from Luxor. He posts a lot of great content in the mining space, and the Hashrate Index also posts fantastic data for Bitcoin mining specifically. But he had this idea that if Bitcoin does see another leg of capitulation, the newest generation mining rigs like the S19 XP actually could, remain stagnant in their market price or even potentially go up. I thought it was a very interesting counterintuitive idea that many people might not realize, but it actually makes a lot of sense because if Bitcoin does fall to 12K or 10K in a that next leg of capitulation, not saying it will happen, but it's possible. There's going to be a lot of old gen, mid gen, and even S19 early gen S19s that become unprofitable at certain energy rates. So these rigs might get unplugged, and there's going to be this extra rack space. And if any miner out there has excess capacity or excess capital, they're going to be looking at, okay, what can I plug in this infrastructure since I already built out all this infrastructure? What rig can I plug in that's actually going to be making money? And if it gets bad enough, the only rig that's going to be making money is S19 XP, or at least that will be the only rig that has, a somewhat significant margin left. So Ethan made the point that, hey, there's not that many S19 XPs. If Bitcoin goes lower, rack space kind of to opens up to more people, and there will be demand, natural bid for these S19 XPs because they're going to be the ones that need to get plugged in all throughout the world. Also in the newsletter, I talk about comparing S9, S17, S19, and S19 XP, so old through new gen machines, and I compared their break-even price for the price of Bitcoin. So at what Bitcoin price would an S9 shut off at, say, 8 cents per kilowatt hour, or an S19 XP shut off at 8 cents per kilowatt hour? And when you look at this chart, you can clearly see that the old gen machines are struggling big time right now. You need extremely low electricity rates to be operating profitably, whereas the S19 XP, as I just pointed out before, it's the most efficient machine on the market. And so because of this, it's going to be one of the last machines to shut off, even if you are operating at a relatively high electricity rate. So if you're operating at 8 cents per kilowatt hour on an S19 XP, you're going to have pretty much all of the S9 shut off, many of the S17 shut off, and many of the early gen S19 shut off before you even get close to shutting your rig off. So it's definitely kind of revealing that safe haven aspect of the S19 XP from what Ethan talked about before. Another quick topic that I wanted to discuss that I saw a few people discussing this on Twitter. Many people are kind of confused as to how Bitcoin's total network hash rate can be soaring amidst so many different problems for miners, right? We've seen the price of Bitcoin, significantly off its all-time highs. We've seen mining difficulty at all-time highs, and we're seeing energy crisis throughout the world, rising energy costs. So how can hash rate be soaring? Many people, or a few people, were kind of pitching the idea incorrectly, in my opinion, that Bitcoin was potentially on the verge of a nation state attack. A nation state was accumulating hash rate at a time when when it doesn't look like people should be accumulating hash rate. But I definitely disagree with that. I don't have evidence or direct evidence to say that a nation state is not accumulating hash rate, but I can explain why I think hash rate has been growing at the rate it has been, without any sort of nation state, attacking Bitcoin. So there's four main reasons why I think hash rate has been growing at the level it's been growing. The first one is that these large S19 XP orders that were previously plugged in, or that they were previously placed during higher Bitcoin prices. So these, last year it made a lot of sense to go ahead and purchase these S19 XPs, but they're just now getting shipped and plugged in, and that will continue throughout 2022. Um, Second reason is there's extra rack space in these mining facilities after the ETH merge. So, as many people know, the ETH merge transitioned ETH from proof of work to proof of stake. So all of those ETH miners either got sold in the market or they're mining some other altcoin, and that's probably significantly less profitable than ETH because there was just this flood of ETH miners that were trying to find another coin to mine. So the difficulty of those other coins went up drastically, and it just became very unprofitable for all GPU miners. So there's this extra rack space now that's basically being filled with Bitcoin ASICs after the merge. The third reason is it's still profitable to mine Bitcoin with new gen rigs, right? So prices of these mining rigs have gone down since all of these difficulties have occurred, and it still makes sense to mine Bitcoin. If you're buying an S19 XP, you're buying it at a highly discounted price from where it was trading last year, at least the futures of the S19 XP, and the if the price of Bitcoin recovers, we're going to see not only the margins of these machines go up, but we're going to see the market value of those machines go up. So there's still people, believe it or not, deploying capital into Bitcoin mining, and that's another reason why hash rate it continues to increase. The last reason is as these old rigs become unprofitable, like the S9 or the S17 or early gen S19s, they're being replaced with XPs or M50s. They're being replaced with the most efficient machines in the market. And when you replace an S17 with an S19 XP, that's a net growth in total network hash rate. So there's a lot of reasons, I guess, why the hash rate is going up at the rate it is. With that said, I think it's, bearing, I guess, no massive surge in the price of Bitcoin. I think it's very reasonable to expect a much slower hash rate growth throughout 2023, just given that a lot of those four factors are kind of going to die out by the end of 2022. Um, the very last thing that I'm going to cover for the mining section is this metric called Bitcoin energy gravity, and it's used to estimate the break-even electricity rate for a modern Bitcoin ASIC. And so this metric now sits at 7 cents per kilowatt hour, which basically means that miner margins are extremely low. And I think historically, this has been the case that is actually a pretty good sign that Bitcoin is in the process of bottoming. Now, why is this the case? And it's basically the case because new capital that's flowing into this industry is really flowing mostly into spot BTC, which would push the price up, rather than flowing into Bitcoin ASICs, Bitcoin infrastructure, mining infrastructure, and energy. So it's kind of this uh, for example, when the energy gravity metric is very high, meaning miners are very profitable, there's billions and billions of dollars flowing into ASICs, infrastructure, and energy, rather than now we have very little capital flowing into ASICs, infrastructure, and energy. And so if people want to get exposure to Bitcoin, they're typically just going to buy Bitcoin. Doesn't mean that that's the right play, but that's what makes sense to a lot of people, at least on paper right now. But that's it for the mining section. I don't know if you guys have any questions or comments.
I really
Joe,
like this. Yeah, you go. Like,
all right, I just wanted to mention it. Maybe it's a little bit of a pivot from what you were just talking about, but I think it's significant for public Bitcoin miners. And that was, this week, and I saw CleanSpark made a tweet about it. So, and they had an article talking about it. So you could probably get more information there. But this week, the FASB, which is the Financial Accounting Standards Board, who basically determines the accounting standards, the GAAP standards in the U.S. And internationally as well. But they this week they made a pivot to allow companies to report crypto assets at fair value, which I think is pretty interesting. And I'm not really going to dive into what that means for the balance sheet, but it does kind of work to legitimize crypto assets from a financial perspective. So traditionally, you had to have crypto assets on your balance sheet as an intangible asset, which is where like your patents go and goodwill and trademarks and things like that. So they considered Bitcoin to be an intangible asset. But as of this week, it can now be reported as a legitimate financial asset at fair value. I just wanted to mention, I think it was pretty interesting, and it just kind of legitimizes Bitcoin as a financial asset versus something that's just intangible.
Yeah, exactly. I know Michael Saylor has mentioned before this happened that this would be a one key to really driving, public company adoption of Bitcoin. Because from my understanding, I'm not an accountant, officially an accountant, but before this, the way that you would account for Bitcoin on your balance sheet is you would actually find the lowest price that Bitcoin traded at in the previous quarter, and that's how you would end up marking it on your balance sheet moving forward. So if Bitcoin, wicks down to 10,000 and then pops back up to 20,000, you would have to actually write that as a loss. And on your balance sheet, you would have to say that Bitcoin is, your Bitcoin is worth $10,000 per Bitcoin, even though this new rule will make it say, okay, now we're just going to actually report what is the current market value of Bitcoin. And you put that on your balance sheet, and it makes a lot more sense.
Yeah,
Yeah, because
100%. Yeah, I
micro
just I just thought it was worth mentioning. Sorry, didn't mean to cut you off,
yeah,
Mitch.
no, MicroStrategy was having to do the impairment charges, and that was like, I don't know, that seemed like a pain in the butt for them, just because they have so much Bitcoin and everything is so volatile. They're always having to constantly devalue it on their books. But I guess they don't have to do that anymore with this change in accounting. But on your mining section, Joe, I'm fascinated by the chart you put in with the different ASICs and then their break even costs. It just shows it's like it's sort of it's just a balancing act, right? And it's kind of simple. There's only two inputs, uh, electricity cost and the efficiency of your machines. Yet there's still such like a wide gap between the efficiency of certain miners. The difference between the S9 and the S19 XP is just tremendous. Like you have to have such cheaper electricity to make an S9 worth it.
Yeah, exactly. And it's exactly why there's this premium during bear markets on the newest generation machines, because if the bear market lasts longer than you expect, you have this buffer to where, okay, Bitcoin goes down to 10K, many more S9s are going to shut off, many more S17s are going to shut off, many more early gen S19s are going to shut off, all before your S19 XP gets shut off. And so these machines shut off before yours means mining difficulty will actually go down before you end up ever considering shutting off your machine. And if mining difficulty goes down, you could actually see your break even price, your Bitcoin break even price go down too. So there's an extreme buffer, an extreme like safety net on the newest generation rigs, even if you're operating at a fairly high electricity rate.
And on the flip side, if we do get like a sudden price run up and you're using an S19 XP, your mining Bitcoin costs you 10K per Bitcoin, and Bitcoin all of a sudden goes to 30, 40K, you're making a huge arbitrage right there. And when the price goes back up, yes, some of the older machines are going to get plugged back in, but I don't think, and correct me if I'm wrong, hash rate probably would not increase as much then as it has been now, because like you alluded to, the hash rate increase now is these newer gen machines getting plugged in. So if the older gen machines get plugged in during a bull run, that's not going to move the needle as much as these new gens.
Yeah, Bitcoin is interesting, right? Where the price of Bitcoin goes through these parabolic bull runs quite repetitively, right? And they happen relatively fast. Mining difficulty, on the other hand, is kind of unique in the sense that it's very difficult to quickly manufacture, deploy, ship these mining rigs, plug them in, build the facilities to plug them in, acquire the energy contracts to plug them in, build the energy resources that are needed to produce that energy. There's a lot more time and energy to building out, this mining infrastructure, whereas the price of Bitcoin can go up extremely fast. And that's why mining typically goes through these insane bull runs after the bear market, because you can't plug in hash rate, like you're saying, you can't plug in hash rate overnight. It takes time. It takes all of that manufacturing, all of the development, all of the energy. It's not something that you can do overnight, and that's kind of what creates in the next bull run or previous bull runs. It creates the massive margins that Bitcoin miners end up inevitably capturing.
That's great. I got one more question I want to ask you, Joe, and then we can go ahead and wrap up. What do you know? Like, do you have any intel on the manufacturing side of these XPs? Are they still getting made? Because I know there was the whole chip shortage thing, and that was sort of affecting the ASIC manufacturing. What's the situation here with the XPs, and then also the new What's miners?
Yeah, no, that's a great question. I know, so I've heard rumors, and I don't have like too much of a deep insight into like the manufacturing in China of these machines, but I have heard rumors that China recently did this citizenship type law or something to where people that weren't directly Chinese citizens had to like or are being forced to like leave the country or do something, and there's basically like an extreme lack of labor to build a lot of the core components of these machines, and so it's very possible that we're gonna see an extreme shortage of them. I don't know if that's true or not, but it will be interesting to see if it does happen. But regardless, I know we're kind of like currently fulfilling all of these large XP orders that were placed, at the beginning of this year and late last year. But right now, there's, definitely much less future XP orders that are getting placed for 2023, at least compared to last year, because everyone wanted to buy these machines. But now, just with the market conditions, it's not like there's massive demand going directly to Bitmain trying to buy hundreds of thousands of these machines. There's definitely still buyers, but it's significantly less than it has been in the past.
Cool. With that, I guess we can go ahead and wrap up. We'll have this on YouTube, and it's also recorded on Twitter. So if you missed anything, you can definitely be able to go back and watch it. Joe, Blake, you guys got any more comments?
Not much on my end. Appreciate everybody listening, and yeah, continue to. The bear market could last longer than we expect, but also the bull market could be here sooner than we expect as well. So kind of be prepared for both scenarios if you can.
Yeah, totally. Couldn't agree more, Joe. Thanks everyone for listening, and have a great weekend.
See everybody.